But in the thick of the Q4 updates, Pralay Mondal, the Managing Director at CSB Bank, joins in on the show right now. Mr. Mondal, great to have you on the show. Your advances growth has been strong. How sustainable really is this number, and how is it that we would, look to grow in the next 3 to 5 years?
Growth was strong, but if you look at quarter on one quarter, I mean Q1, Q2, Q3, Q4, when you look at every quarter growth over the previous year same quarter, every quarter we have improved that growth run rate. Even last time I was asked the same question, how sustainable it is, but we have done it better this quarter. So the point is we are very small as a balance sheet, and hence I don't see that challenge in terms of sustainability on a base like this. And we have our new products and new businesses to pick up as well, because so far our large part of the growth has happened based on gold loans, but now you can see this quarter we have started doing some more on the retail assets. SME has done better, even wholesale is pitching in. So to that extent, it is getting little more composite growth, and those are the things which will pick up in the next 2, 3, 4 years. In the beginning, when I started talking to the media on our bank's growth trajectory, I have been telling that we will grow 30 to 50% faster than the system. Maybe we have done a little bit more than that, but what is sustainable definitely is 30 to 50% faster than the system.
Right. Your gold loan book is around 50% of the total mix and, continues to see good growth as well. What's the larger strategy here, and where exactly will the mix be over the longer term?
No, absolutely. I can give that perspective. So when you look at a slightly longer term, because in this bank right now, we are not looking on quarter or year just like that. We are looking at our SBS 2030 vision, which is Sustain, Build and Scale 2030 vision. And there we are very clear that our long-term perspective for 2030 is 20% gold, 30% retail, 20% SME, and rest is between wholesale, securitization and all that. So to that extent, we have to take that growth trajectory. But to do that, we are making significant investment into technology right now. As we're talking, already have started, and next 1.5 years will be significant investment. And to ensure that our ratios are maintained, we need the right revenue in the bank. So gold loan gives us the right revenue because most of the investments are baked in, operational costs are baked in, so you can sweat the system and create more efficiency to build larger businesses. That's what you're doing. Can gold loan take us to the kind of a trajectory in terms of balance sheet growth, what we want by 2030? Answer is no. Alone, it cannot do it. But when other businesses starts picking it up, then we have 3, 4, 5 cylinders firing, and that's the time we can reach that kind of a number which you're looking at by 2030. Having said that, in the next 12 to 18 months, gold loan will remain the main investment. The revenue from gold loan will be helping us invest into the other businesses, because there's a hell lot of money we need to invest into technology, distribution, people, leadership, sales. We are starting, as we are talking, a very strong sales machinery on the liability franchise. And that's what I want to talk about at some stage, that how finally the liability franchise will decide how our growth trajectory goes in the long run. So we are investing into that, and for that gold becomes very important. And hence we will continue to grow the gold loan business in the next few years. And then gradually other businesses will pick up, and that will give us the kicker to grow the overall franchise sustainably over the next 7 to 8 years as per our SBS 2030 strategy.
So you hinted about your liability franchise being strong this time around. So let's talk a bit more about that. What is driving this growth and helping you stand out? And how confident are you of sustaining this 20% number when it comes to the deposits and the liability side?
No, absolutely great question. So let me break it up into two parts. One is building up a granular, long-term, sustainable liability franchise, and one is funding the growth. So what we are doing right now is funding the growth, because at this size of the balance sheet, funding the growth comes in various processes. You can do refinance, you can do CDs, you can do build your CASA, you can get FDs, you can get larger FDs. So it's a combination of all this. But fact is that I think in the next year we'll sustain this, because this year we have not taken any large business which will run off in the near future. So we had some CDs last year in the base. So actually, this growth is will relatively be more realistic right now on a base which was sitting same time last year. So to that extent, I think we have really built up a very good quality liability franchise, which will be liability or funding franchise, which will continue for some more time. Having said that, the real effort which we are putting now, increasing distribution and increasing the sales machinery, because we need customers. See, at the end of the day, it's not deposit, it's not assets, it's not payments, it's not fees, it's customers. And we are putting a huge, large sales structure in the system in this year plan so that we build up new customer base. And as we grow our customer franchise, customer base, it will not only help us in building the liability franchise, granular liability franchise more, but it also gives us cross-sell ability in fees, assets, payments, and many other businesses. So clearly, funding, I don't see any issue in terms of whatever growth we want to do in the next 1 to 2 years. And by that time, the entire granular franchise will start picking up. Having said that, I must say that most of our liabilities are 1 year plus, very sticky in nature, and none of these are sort of what you call within quotes managing the book at the end of the quarter. All of these will be with us for the foreseeable future. So we have built up a very strong liability base and will continue to build that.
Okay, let's talk about the NIMs and ROAs going forward as well, because you manage a number of 5% thereabouts on NIMs. Is that sustainable as well? And going forward, what kind of return on asset ratio should we pencil in?
No, I'm not targeting 2%. So let me tell you, I'm sort of repeating what I told last time, is the kind of names which we have been working on is not sustainable. As you know, the entire industry is going through our interest rate cycle change. So given that perspective, cost of funds with a lag is going up, and hence the interbank ecosystem will have some competition on NIMs, and it's no difference to us. And I have no such this thing, a commitment that we have to retain the NIM at that stage. I have said that between NIM and growth, if I have to pursue one, I will pursue the growth and not necessarily the NIM, because at the end of that is a final profit is a multiplier of these and some other aspects. So given that perspective, I think somewhere around 5% is a good name. In fact, it's a very good name when you look at from an industry perspective. I'll be happy with a 5% kind of a name. And on the ROA, I have given that in the long run, we will be between 1.5 to 1.8. And I'm quite happy being in that range. So because as soon as you start targeting a 2% kind of ROA consistently over the next 7 years, you will sacrifice quality or sacrifice business. So if it happens once in a while, it is fine, depending on whether you get treasury income, whether you're on the right cycle, on that interest rate cycle, and so on and so forth. But on a sustainable basis, I think somewhere between 1.5 to 1.8 is a very good ROA if you can sustain this kind of a growth.
1.5 to 1.8 on a return on asset is the sustainable number. Thank you, Mr. Mondal, for joining us today and talking to us about the outlook.